In today's video, we are going to talk about the Indexed Participation Feature Rider. So this is one of my favorite riders to be aware of when it comes to a whole life insurance policy, with the exception of the PUA rider. But what the Indexed Participation Feature Rider is, let's call it an index rider. It allows you to tie your cash value or link your cash value to the S&P 500 index with a pure whole life insurance product, not an indexed universal life policy. But you can tie your cash value to that S&P 500 index, and in summary, it provides a little bit greater earning potential than what you would have with a basic dividend-paying whole life insurance policy. Now, there are some items to be aware of with respect to the pros and cons, so we're going to go through exactly that, and then we're going to demonstrate one policy with exercising that indexed rider, not exercising it, and then blending it. Did you know that you can have a whole life insurance policy and tie 50% of your cash value to the basic dividend and 50% to the S&P 500 index? And you can actually change it each year. Fun stuff. We're going to provide some more detail. All right. So what we've got here, the indexed feature rider, what it does is it allows your cash value to be tied to the S&P 500 index. And what this does is give you greater upside potential with respect to cash value earnings. How indexing works is if the S&P 500 index goes up, your cash value goes up with it. And if the market goes down, the S&P 500, you do not participate in its losses. You would still receive the guaranteed rate, or the guaranteed floor is the specific language we want to use in this case. So you've got upside potential where you can participate with the market earnings. Now, this is still a whole life insurance product and still has a guaranteed floor. So why I want to emphasize this point, or what's important to be aware of, is that this is not an indexed universal life insurance policy. You still have a whole life insurance product at its core with a guaranteed level premium and a guaranteed rate that will exceed the insurance expenses. Where in IUL, the insurance expenses will exceed the premium. That's why when I look at the guarantees on a whole life compared to an IUL, whole life will continue to go up, whereas IUL will go down, again, being laser focused on the guarantees. This is still a whole life insurance product. Now, what I will add here is there is a fee for the years we want to use this indexed rider, and how that fee works is that it is a percentage, and it's a percentage of your cash value that is tied to the index. So what I mean when I say that is the fee, you'll see it typically range between 2 and 3%. It's usually at 2%, but companies do reserve the right to increase it. And if I have 100% of my cash value tied to the S&P 500 index, then that 2% fee will be assessed to 100% of my cash value. If it's 50% of my cash value, so I've got 50% of my cash value tied to the S&P 500 index and 50% tied to the basic dividend rate, then that 2% fee will only be assessed to the 50% of my cash value that's tied to the S&P 500 index. And again, we can adjust it year over year. So let's provide some more information on this. We're going to go through a couple demonstrations here as well. So before we jump into this description, I want to hit on some of the literature here from an illustration. So this is specifically with Guardian. And quick side note, not all companies offer this indexed rider with whole life insurance products. If you were to look at the 4 major mutual companies, as of the day of shooting this video, November 2022, it is just Guardian, and it has been just Guardian for several years, since 2016 when they released the rider. And some other smaller companies do offer it as well. There's a couple of them. One of them is AUL, American United Life. I know they offer this indexed participation feature, this rider as well. So to provide a little bit of info on here, there's a lot, but just going through a couple key items here. If we start with this index, what's the actual index that is used? S&P 500 index. Next, index crediting method, annual point to point. What that means is when the indexed period begins with your whole life insurance policy, let's say it is January for simplicity, it's usually going to be on or right around the month of your policy anniversary date, but let's say it's January, and let's start 2023 for simplicity. What'll happen is the insurance company is going to look at what is the S&P 500 value the month of January 2023. And then when the next year rolls around, so 12 months later, January 2024, a full year, annual point to point, from point A to point B, how much was the increase? If the S&P 500 grew by, let's call it 10%, what would happen here is you would participate in the earnings of 10%. Now, I do want to emphasize the point that this is a gross rate, just like a dividend rate or a guaranteed rate is on your life insurance policy. So if I had $100,000 in cash value and the S&P grew by 10%, that's what was applied to my policy, I would not see $10,000 in earnings that particular year. It's a gross rate. We want to factor in the actual insurance expenses and look at the internal rate of return, which we will as we progress through this video. So annual point to point just means they're going to look at what's the S&P 500 value at the beginning of the year or the beginning of my policy year based on the month that I've started, and then what is it 12 months later. And if there's an increase, I participate with the increase with the exception of what the cap is. If the market goes down, I still have my guaranteed rate and my guaranteed minimum floor. So what do we see next? This is important information. We see when the rider is exercised, current floor, 4%. Current floor, keep that in mind. What do we see next? Current cap, 11%. What this represents is if the market increases, let's say by 30%, like what we saw in 2019, the S&P 500 grew by approximately 30%. It was a strong year. If you had your Guardian policy or any policy with an index rider tied to the S&P 500 during 2019, you participated January to January, 30% growth, the cap here is 11%. That means the earnings cannot be greater than 11% or whatever the current cap is. That can change over time. Current participation rate. In this example, we've got 100%. What's important to note about this is we can adjust it as the years pass. It does not have to be all or nothing. We'll look at a couple of examples there. And then current rider charge, 2%. So if we decide to use this rider, we want to turn it on and have our cash value tied to the S&P 500 index, not to the basic dividend, then there will be a 2% fee assessed to our cash value. And think of it this way. If you have 100% of your cash value tied to the S&P 500 index, then that 2% fee will be assessed to 100% of your cash value. If it's 50%, then what happens? The 2% fee is assessed to only 50% of your cash value. All right, let's continue on here. Hit on some more bullet points. Guarantees. So, like most riders with life insurance policies, the insurance company has guarantees, meaning they reserve the right to make adjustments to the charges and what the floor and the cap rates are in the policy, and that does have to be disclosed to the policyholder. So here, we see the guaranteed minimum floor is always 4%, which is nice. In the event that I have 100% of my money tied to the S&P 500 index, and let's say it flatlines or goes down, I know I've got the minimum floor of 4%, but if it's the current rider charge, the 2% will be deducted. Here, the guaranteed maximum rider charge is what? 3%. So if they want to charge more for that rider, they can. Now that will always be disclosed to a policyholder, and you'll see what the charge is on your annual statement. You can always ask us as well or your agent, but we do want to know what that is. Guaranteed minimum participation rate, we can never, or that'll never change. So we can always link 100% of our cash value to the S&P 500 index. But here we see guaranteed minimum cap, 8%. So how I look at that is, if the cap's 8%, let's say the cap is 8%, and let's also assume that the charge is 3%. That brings me down to what? A gross of 5%. When I say gross, is because if I were to look at a dividend rate of 5%, am I actually earning 5% on my money? No. The dividend rate is a gross rate that is applied to my cash value after the insurance expenses, mortality charges, everything that comes with the life insurance policy. The same thing applies here. So the question is, would it be worth, if I've got an 8% cap and I saw the charge increase, would it be worth me turning the index rider on if the dividend rate was greater than 5%? I don't know. Probably not. This is an unrealistic scenario, but at the same time, I'm explaining or attempting to explain some of the drawbacks here. Let's scroll down a bit more. When we look at the indexed rider illustrations, what it is based on, because this rider is relatively new, it was released with Guardian in 2016, is they're going to look at history of the S&P 500 index. They're going to say, okay, here's what the person would have gotten if we would have had this rider available back then in 2002 with whole life insurance policies. So we see the beginning value of the S&P, ending value of the S&P, the index performance rate. So here in 2002, we see that it took a loss. So what would happen? S&P took a loss. I've got that floor of 4%. That's why I see 4% there. Next year, jumped back up 26% when I look at the gain from year to year. I've got that cap of 11%. That's why it's not the full 23% or 26% and change. Now, look at 2004. There was a gain just under 9%, and that's what the policy would have received because it's under the 11% cap. See where I'm going with this? So I always want to look at this, but knowing that if it's less than 4%, the gain, so if there's a loss there, I'll still have that floor there. If it's greater than 11%, the actual earnings over here, then I'll see the cap over here of 11%. And then if it's anywhere in the middle, well, then I'll see that's what's actually applied to the policy. Not too many years where it's in the middle there, but it is good to be aware of that when I'm looking at this. And this is hypothetical because when this was first released, this rider in 2016, the cap rate was 12.5%. Now it's 11%. Right, so things change. So just like the actual performance of a policy, how we measure that as the years pass, if we're heavily using the indexed rider, we want to do the same thing. So let's take a look here at our whiteboard. We're going to hit on a couple items. If we have no indexed rider, a basic dividend-paying whole life insurance policy, what will we see? Well, we've got an L95 product here that we're going to look at as the demo, which does not have a 4% guaranteed rate. Old habits die hard. It's got a 3% guaranteed rate. Then I've got a surplus of what? 2.65%, which gives me the total dividend interest rate for Guardian in 2022 of what? 5.65%. Quick side note here, anytime you see a dividend column on a life insurance illustration, that's going to reflect the surplus rate, not the total dividend rate. I wish that it did, but just how the terminology works in the life insurance industry, it does not. Now, this is basic dividend here with no indexed rider. You could have the indexed rider attached in this scenario, but you've got the allocation at 0%, which is the exact same thing as not having it at all. If you have an indexed rider attached and it's at 0%, then there's no charge at all. The charge, again, is only exercised when we turn the indexed rider on. So, turning the indexed rider on, what happens here? Well, the guaranteed floor, we see a little bit different terminology here, is 4%. Sweet, it was 3, now it's 4, not so fast. What we get as far as the surplus is whatever the S&P 500 index produces. We're just going to put a percentage sign there because that's variable. And then the crediting rate is, again, whatever the S&P 500 index produces, with that 11% cap right now. Now, additional info. We've got a fee if we turn the indexed rider on at 2%, which in many ways brings that floor down to 2% if we look at things right now. Cap, we hit on this already, the 11% cap. Allocation, so what we're going to look at a couple illustrations here with a 100% allocation, 50% allocation, and 0% allocation. What that means when I say 0% allocation is up here, we've got cash value at $100,000. So let's assume you have a whole life insurance policy, the cash value is $100,000. If you have a 0% allocation, what'll happen here, let's do this. So a 0% allocation would mean that you receive the basic dividend rate at 5.65%. So it'd be a dividend illustration. That's what we would look at in that case. Nothing is tied to the S&P 500 index. Now, if you go 50%, what would happen here is that would mean of that $100,000 in cash value, 50% of it, or $50,000, is still tied to the basic dividend. So let's call it here in green, dividend at 5.65%, if I can fit it, beautiful. And then we've got the other 50,000 that's tied to the S&P 500 index. So middle of the road option there. Now, a side note here as well, that 2% fee, that will only be applied to the percentage of cash value that's tied to the S&P 500 index, not the other 50K that you have tied to the basic dividend. And then with the 100% allocation, well, that means you've got 100% or $100,000 tied to the S&P 500 index, and the 2% fee would be assessed to the full $100,000. Now, when we look at illustrations, which is just an illustration, looking at the net cash value in net death benefit column for that matter, but let's focus on the cash value, that will include any fees and charges that are assessed with the policy. So if you're just trying to get the net growth rate, what I would look for, the term to use that insurance companies and agents can use from a compliance standpoint is IRR, internal rate of return. What's the net internal rate of return? So let's take a look here. We're going to look at 3 illustrations. What we will look at first, and you'll see all of these illustrations are identical. We're going to look at funding a policy at $100K per year for 7 years. Just max fund it. MEC limit's a little over $100K, but we're just going to juice this thing, and the aim here is to maximize the internal rate of return. What do we see here? $100,000 total going in. Here's my base premium. $9,000 and change. Where we came up with that is because if you look at the PUAs over here, they come out to 10x that base premium, which is the maximum we can illustrate going into the policy each year, except for the first year we can 50x it. But this is, we're maxing it out based on the MEC limit and company limits for 7 straight years, and then we shut her down with a reduced paid up option in order to no longer make payments, which is optional there. But what this is, here's what I want to hit on. Let's put this in a different color. Let's put this in light blue. Index participation feature. What's the allocation there? 0%. Initial allocation. Why it says that is because you can adjust it as the years pass. So 0% initial allocation. Let's look at the next illustration. Identical from a design standpoint. When we look at where the money's going. Over here. What do you see here? 50% initial allocation. This means 50% of your cash value is tied to the S&P 500 index, and the other 50% is tied to the standard dividend rate, 2022 being 5.65%. Then let's look at one more illustration. Again, identical design. Everything's the same. The only thing we did differently here was change that index rider allocation and see if we get more or less cash value by cranking that index rider up, tying more money to the S&P 500 index. And remember, the cash value projections here, the illustrated values, are based on that S&P 500 history. If we go back to that sheet that dated from 2001 to present, so about a 20-year history there. So looking at that, what's the potential here when we look at everything? Potential being the key word. Well, if you've been looking at the values here, you can tell pretty easily that as we continue to increase the S&P 500 index allocation, here's 100%, you're over 900,000. If you go back 50-50, you're at 876, and this is by the 10th year. And then if we go back to the basic dividend, you're at 852. Now, this is all non-guaranteed. What's interesting about this stuff, if we looked at the guarantees, be a little bit flipped because the example with no additional 2% fee will have the highest guarantees. Anyway, let's look at a side-by-side here. This always helps me. So here we've got those illustrations we just looked at. We did include the annual dividend column as well, so you can see the impact on that. And option A is what most people are used to, 100% dividend. There's your base premium, there's your total annual outlay, first year, $100,000 goes in, you've got 83, almost 84% right out of the gates. And this is Guardian's L95 product with their 10% PUA fee. And again, that 10% is gross. The cash value is your net value. But my point to this is they do have that 5% PUA fee available for this product, which obviously has much more cash value upfront and an earlier break-even point. But I just want to clarify that point. So first year, about 84%. Second year, 100,000 goes in, you're at 182. Third year, 100 goes in. First year that we see actually more than our payment show up in cash value. I paid in 100, I got a little bit more than that 100K back. And why we're highlighted in yellow here at year 5 is a result of the break-even point. You've paid in $500,000 and you have $500,000. And then by the 7th year, there we go, 700 in, 741 in cash value. Now, quick side note here, this is important if you're trying to understand how the dividend column works. So this is based on Guardian's dividend rate of 5.65. Their L95 product, their guaranteed rate is what? Remember what it was? 3%, which means you have a declared surplus of the difference between the guaranteed rate and the total illustrated dividend, which would be 2.65%. That's what this column represents. And that's the case with all life insurance companies. It's not just a Guardian thing. And you'll see that if we go back to the illustration here. My point to mentioning that, look at year 8 when we pay nothing in. This is the best year to demonstrate it because I don't have any payments going in. What's your dividend? 16.5. What'd the cash value grow by? About 35. More than the dividend column. A lot of times people ask, like, what's going on here? The answer as to what's going on here is that this does not include the guaranteed portion. It's a big reason why. So anyway, we've got the basic dividend here. Let's look at 50-50, meaning 50% of your cash value tied to the S&P 500 index and 50% tied to the dividend. First thing I want to hit on, look at the first 3 years. See that bold line there? I'm going to underline it in red now. Dividend, 50% index. Do you see any difference in the values during the first 3 years and the cash value or dividends for that matter? You don't, and you won't either. The reason why is if we have a term rider, particularly a 1-year term rider attached, which allows us to 10x the base premium and plow money into PUAs, if that is attached, that indexed rider can be attached. We can even put it at 100%, but it will not actually kick in until after the 3rd year. Now, while we can put it at 100% during the first 3 years, we're not getting anything, but at the same time, they won't assess the fee either in the first 3 years. It's just as if it's at 0%. However, beginning the 4th year, now you'll see a difference all of a sudden. The dividend column's higher in the illustration, the cash value's higher, the long-term values will be stronger as well. You look at year 20, you can compare them side by side. And this does account for the 2% fee. So it's net here, assuming everything remains as is forever, which won't happen. And then you've got the same thing with 100% indexing. So it does grant a little bit greater potential. Again, potential is the key word because it's all non-guaranteed. You know, a lot of people we work with, they'll often express this. They'll say, okay, I want a whole life insurance policy. From an expectation standpoint, it's likely going to fall somewhere between 3 to 5%, the net IRR, if it's properly designed with one of the major mutuals based on everything we've always seen and what we're still seeing today. However, that indexed rider does grant you the potential for a little bit greater cash value as the years pass. What a lot of people like the idea of, they often attach it, and if they see a major market correction and they feel that there's going to be a long-term rebound, or maybe it's short-term, what they'll do is have that indexed rider available on the side to say, you know what, if I'm going to turn it on, maybe it's 30%, I tie the S&P, 50%, whatever, I'm going to turn it on in the future, and I'll let it ride at that point in time. But it's a good option to have to flip on when the time comes, when you're comfortable with it, if you decide to attach it. If you attach it at 0% and leave it at 0%, then it's as if you never had it. So we can look at the IRR, 100% dividend. This is the annualized IRR, not the average. A little bit greater potential. It's really what it gives. And we want to track it year over year. But a great rider to be available, to be aware of. Well, the loan treatment is the same as any standard Guardian policy is, which I would check out our All About Guardian video, which goes through loans. You'll see that up top. But the loan treatment is the same regardless if I have the indexed rider attached or not, as far as how Guardian applies dividends to loans if I've got the fixed loan rate. But I hope that this video was helpful. If it was, please let us know. Please hit the like button, subscribe for more. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.